Well, welcome everybody. My name's Emily Sims. I'm one of the staff here at Prosper Australia. Thank you for coming along to a capital effort, what the ACT can teach the other states about land tax or reform. It was my best pun effort for the year, I think. In the spirit of reconciliation, Prosper Australia acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander Australians. Prosper Australia is one of Australia's oldest research institutes. Our work aims to hold a light to dusty corners of our economic systems that aren't working for the common good. In particular, we believe the missing piece in a lot of economic and taxation analysis is land. Today, we're here to launch our second study of the ACT stamp duty to land taxation reform. We have our author here, Warwick Smith. Warwick is an economist, biologist, and co-founder of the Castlemaine Institute. He has previously worked with Per Capita and is an honorary fellow at the Melbourne University. He's a lead author, as I said, of our latest ACT report. He is joined by some illustrious figures in Australian taxation policy. We have John Freebairn, professor, holds the Ritchie Chair in Economics at the University of Melbourne and is, as I said, a superstar of Australian tax policy. He recently served on the panel of New South Wales Federal Financial Relations Review, and he is in good company with Dr. Tim Helm, who earned his PhD in economics from the University of Melbourne. He has worked with the Grattan Institute, with Ernst & Young and the Victorian Department of Treasury and Finance. He is also the author of Prosper's Designing the Transition report, which was released several years ago. So we're going to begin with introducing our latest ACT report. Warwick, would you say that the reform is achieving all of its objectives?
Yeah, the ACT government set out to improve revenue predictability, and they're achieving that. They wanted to improve taxation equity, and I think they're achieving that through spreading the taxation burden more evenly amongst ACT residents than it was. So yes, I think they are achieving their stated goals. There's more to it than that, and more complexity, of course, but. Yes.
Well, maybe you could take us through some of those complexities. I've got a question here, which was what was the least surprising finding from this report? Maybe you'll run us through the key findings and
yeah, sure.
Tell us what you weren't surprised to find.
I've got a couple of slides that I'll share. How's that working for everyone?
Yep.
Okay, so I think from my perspective, the least surprising finding, and though this may be surprising to some or perhaps disappointing to some, was that the sky didn't fall in when the reforms were implemented. You know, there is a lot of scare campaigns politically around tax reform and land tax in particular, and there's often, you know, the sort of threat that we're taxing the family home and it's going to cause prices to crash. And as we can see from this graph, ACT is the dotted line. The reform period starts right in the middle. And, you know, the ACT has been roughly tracking Melbourne since the reforms, and prices have been booming. So, you know, the sky didn't fall in, prices didn't crash so far in the reform period. And I think based on what we've seen now, we can reasonably confidently say that the continuing reforms are not going to cause the sky to fall in. But of course, what we don't know from this graph is where these prices would have been if the reforms hadn't happened. You know, would prices have been lower? Would they have been higher? And the sort of complexity, I guess, is in the fact that we expect a reduction in stamp duties to increase prices because it reduces the overall cost of purchase, and perhaps most importantly, it reduces the upfront cost of purchase, which is a big barrier, particularly to first home buyers. But that said, we would expect increasing rates, land taxes, to reduce prices. So we've got these two competing effects, and we would expect land taxes to decrease prices because people factor in the future payments that they have to make into their sort of calculations about cost. So in the absence of a counterfactual here, like what would have happened without the tax reform, it's very difficult to know what's going on with prices. So as a shot at a counterfactual in the report, we had a look at price comparisons between Canberra and Queanbeyan. Queanbeyan's a town in New South Wales that's right on the border with the ACT and is in essence part of the same housing market. There are people who live in the ACT and work in Queanbeyan, and 20,000 people who live in Queanbeyan and work in the ACT. And so, they are part of the same housing market. And interestingly, and this was quite a surprising finding, what we saw was this pattern you see before you, which is that before the reform, there's no clear sort of pattern between, I should say this graph is showing you on the axis, Canberra prices divided by Queanbeyan prices. So you see, when you see the index rising, it's showing that Canberra price relative to Queanbeyan is going up. So that's what we saw once the reform hit, was Canberra prices relative to Queanbeyan actually increasing. So the implication of this, because Queanbeyan is the same housing market but isn't going through the tax reform because it's in New South Wales, the implication of this is that the reforms were resulting in increasing prices. Now, again, it's only an implication because there's more complexity involved in terms of what changes are going on in the housing markets of both Canberra and Queanbeyan, and the analysis attempted to control for that. So, we looked at established housing and established suburbs in Queanbeyan so that we weren't being driven too much by the effect of the new suburbs in Queanbeyan. But of course, the building of new suburbs in Queanbeyan affect the prices of older suburbs. So that, the teasing apart of this, but this is quite challenging, but this is indicative at least that the reforms were increasing prices. So that was perhaps one of the most surprising findings, and how strong that pattern is.
It's quite interesting because in their stated objectives, the ACT government really didn't have a strong objective around housing or housing affordability. They were more concerned really with things like revenue stability and the equity of the tax base. How are they tracking on those sort of indicators? Because the housing situation is quite interesting, and as quite nerds on this subject, we want to see the empirical effects of the new tax. But tell us about the findings that we have for those key aims of stability and equity, and neutrality as well.
I'll come to the stability in a moment. There's a bit more of a conversation, I guess, to be had about prices just very quickly before I go on to that, which is that we expect, with the increase in land taxes, as I say, for people to factor that into future price, to factor that into the purchase price, they factor in their future costs in the ongoing land tax. And I think in terms of commercial prices and investors, we've seen that effect happening. So investors are pulling out of the market in housing, and commercial prices are staying pretty flat. So there's this rational calculation going on in terms of factoring in future costs for people who are making money out of their real estate. But for people who are buying real estate as a home, who are looking to buy a home, their major factor and their major hurdle is the initial purchase price. And I think for most people, they just don't really think that much about the future land tax liability, assuming they can afford it. If they can afford it, then they don't really factor into prices. They're still just sort of maximizing the best home they can get in the best location with their capacity to purchase. So it kind of makes sense that while investors are pulling out of the market, homeowners are coming in and they're still willing to pay high prices. So they're sort of driving that. It's homeowners that are driving that sort of strong growth in the market. And I think that there's an equity issue there too. So there are more homeowners in the market now than there were entering the market now than there were prior to the reforms. So I think that's an important equity consideration.
It's a fantastic it's an fantastic leveler in terms of allowing people to have access to land and housing. But we may have jumped ahead because we've got a question here from an American friend who's like, for us foreigners, can you give us a rundown of what the actual reform was? We Australians are really familiar with this particular tax reform, but Warwick, perhaps you could describe what the actual change has been in the ACT.
Sure, and apologies for not doing that up front. So the gist of it is that the main part of these tax reforms is the abolition of stamp duties, which are an upfront charge on the entire purchase price. It's the abolition of stamp duties and the replacement of that revenue with ongoing land tax levied as local government rates. So the land tax is levied quarterly, charged quarterly for all properties. And because of the sort of shock effect that this sort of transition can have, the ACT government decided to phase it in over 20 years. So there's the period began in 2012 and will run for 20 years where they're very slowly bringing down the stamp duty and incrementally increasing land taxes. So I think that's, in the short time that we have, that's kind of summary of the reforms that are happening. So this piece of research is happening at the 8-year mark in that 20-year transition. So we're not all the way there yet, and we haven't seen the full effects, but it's been going for long enough to have a reasonable idea of how things are going to go in the future.
So, Warwick, what do you think are the challenges facing this reform? We're going to hear from the other panelists later about the detail of doing this in the other states. I think it's worth explaining to our guests that the ACT is a small territory within Australia, and they're the first to undertake this reform. So they're a guinea pig or a testing ground for what may or could occur in the larger states. What do you think are the challenges facing this reform in the ACT?
Yeah, I think the challenges are pretty profound, as they've been discussed many times, which is the biggest one being what I was sort of alluding to before, that I think when homeowners who are going to live in the place make a purchase, they're not really factoring in ongoing costs too much in that purchase decision. And the steadily rising rates appearing in their letterbox every quarter is something they then notice. And so you've got the stamp duties coming down. So for existing homeowners, the stamp duties are coming down. It's not making much difference to their lives, but the rising rates are being noticed, and people start to complain when they see their rates going up. And so I think that's the risk. The risk is political, and the ACT have just had an election in which the opposition were promising to pause the rate hikes. They were unsuccessful in their campaign, but should they win in the future, while the reforms are still, while the reform process is still ongoing, there is a risk that they will undo the reforms or at least stop them, and the Labor government will be under probably constant pressure as well from people who are complaining about the charges. So I think that's clearly the biggest risk, is just those ongoing costs rising of people's rates.
Thanks, Warwick. Well, we might move to John. John, you were on the panel for the New South Wales Federal Financial Relations Review, which was a recent, quite in-depth review of the taxation relationship between the states and the federal government here in Australia. The Thodey review, that review, found there was substantial benefit in New South Wales following the ACT's lead. In Canberra, they replaced insurance duties and stamp duties. What taxes ought to be scrapped in New South Wales, and what tax mix and rate of tax, particularly land tax, might replace them?
There are three sets of taxes that you might want to replace. The first one, that's stamp duty, And so the story is, if you sit in your house forever and ever and ever, you don't pay stamp duty. And that gives you a kind of incentive to stick in the same house, regardless of where you've been offered a new job, whether you've got more kids or kids leave and whatever. So it gives us a very inefficient utilisation of our limited housing stock. And a number of estimates say that the cost to the economy of $1 of stamp duty is not just $1 of tax, it's at least $1.50 by not using our housing stocks properly. The second tax that's pretty inefficient is the current land tax. It exempts owner-occupied housing, which is about 60% of the land value, but it falls on rental housing and it falls on commercial property. And clearly broadening that base and lowering the rate would give us efficiency gains. And then the third set of taxes is we've got these special taxes on insurance. And so that's kind of a disincentive for people to take insurance. And what we find, of course, is it's mainly people on lower incomes who don't take insurance or underinsure. And when a disaster happens, they're in trouble. So we look at stamp duty, the current land tax, and special taxes on insurance as being very inefficient and also being very inequitable. Now, here's the sort of interesting story. If you stop in your own house for 30 or 40 years, you pay no stamp duty, and yet you're enjoying government-provided education, health, and whatever. On the other hand, if you chop and change your house every 5 years because you get married and divorced and married and divorced, you get different jobs everywhere, you pay stamp duty every 5 years, and yet you're still consuming the same amount of health and education. So the case of getting rid of these taxes is really, really compelling. So the question then is, what's a real simple, easy way to replace them? Well, in terms of simplicity and efficiency, the most straightforward one is just have a broad-based land tax at a flat rate. That would have almost no distortion costs. So you're making 50 cents plus per dollar of tax revenue switch, and it's much more equitable. But then asks the question, that's a big change from what we're doing. So you might ask yourself, am I going to modify the details a little bit? Given that I'm replacing stamp duty with a progressive rate tax and land tax with a progressive rate, maybe I'm going to have to make the replacement land tax progressive. Okay, it's not as simple, it's not as efficient, but it's more like the current tax, and that's what the ACT have done. So I think that suggests you go for a progressive rate to sort of make the transition. There have been questions about whether you might also use improved value of property as a tax base rather than land, because that's what the current stamp duty is on, improved value rather than land. The ACT went for land, and for a lot of states, you would use the local property rate system, and land is what you've got. The simple and efficient tax system would be the same replacement tax on owner-occupied land, on rental land, and on commercial land. But that would have quite large redistributional effects, because what we know is the current land tax that we want to get rid of as part of a new one doesn't fall on owner-occupied land, but falls on rental and commercial. So my guess is you would want a slightly higher tax rate on rental property and on commercial property in this reform package. So that's the kind of longer term design issues. We then have some challenges about the transition. And so, the simplest model is what I would call the cold turkey. So if we were to go to the ACT model, you went up to 2012 and any property bought before then had paid stamp duty. And then in the 1st of July 2012, you jump straight onto the replacement land tax. Then you'd levy everybody with the new land tax. My God, won't we get complaints from people who just bought a property and paid stamp duty, and now they're going to pay the new land tax. So that suggests that maybe we have some transition relations. And so the ACT model was to say, let's gradually reduce the stamp duty rate and gradually increase the replacement land tax rate. And that's roughly revenue neutral. It gets rid of a lot of the perceptions of double taxation. But it takes 20 years to get onto the full economic benefits. So an alternative model is the idea of giving a partial credit for people who've recently paid property and paid stamp duty. So you might say for people who bought property in the first part of 2012, they don't pay land tax for the first year. They pay, say, 50% in the second year after, 20% 2 years after, and so on. And that would gradually phase it in. That overcomes some of the perceived equity problems. It gets you the efficiency gains pretty quickly, but it does involve a short-term revenue loss. And so there's a question of what rate you do that and whether you worry too much about the short-term revenue loss. And some would argue we're now coming out of the pandemic. Let's run a deficit for a couple of years, and then in 4 or 5 years' time, we'll be back on top. Another option is to slightly load the future land tax so that present value, it breaks even. Another important design issue is what we call for the liquidity constraint. So one of the nice things about the current stamp duty is when you buy a property, you generally got access to finance and you can pay the stamp duty. When you move to the land tax, this is really an increment to your local government rates. And for some people, the so-called asset wealthy and income poor, they can't have access to funds to pay it. There are others who have short-term unemployment or ill health. And so what we would generally propose is allowing people in these special circumstances to carry forward this new land tax and index it to, say, the government borrowing rate. And so that would largely overcome the liquidity problem, but still be equitable between these different people. And the final challenge, of course, is sorting out Commonwealth state financial relations. Because what we know is the allocation of the goods and services tax partly depends on what the states gain from their own taxes. And so I think we need to have involvement of the Commonwealth and the states in seeing that states who go in for this very valuable property tax reform are not penalised via their allocation of the goods and services tax. So there are a number of different options that you can follow. The ACT has shown us one interesting model, but there are other twists and turns that I think individual states and the Commonwealth will look at to provide a basis for a much more productive economy. That's the only way we're going to boost living standards. And when it comes to the crunch, a bigger, more productive economy is going to be the easiest way to repay the huge debt that we're building up over the COVID-19 crisis. So those are some of my thoughts, Emily.
Thanks very much, John. That was a very thorough overview of the design issues in front of us, as you know, for New South Wales and for Victoria going forward. Tim has looked at these questions in the Victorian context. So perhaps, Tim, you could let us know if you could design a stamp duty transition for Tim Pallas, the current Treasurer of Victoria, what would be in it?
Yeah, thanks, Emily. And thanks, of course, for the invitation. And first of all, congratulations and thank you to Warwick and Jesse for this report, which I found to be interesting and useful. And obviously it is coming out alongside reports commissioned by the ACT government into some of the same questions. And you've saved me having to read more than 100 pages of econometrics from NatSem. So there's multiple uses of your report. Thank you very much. So to get to your question, Emily, I'll just, if you don't mind, I'll touch first on a couple of things in response to what John has said. Now, one is about bundling this reform with abolition of insurance tax. Now, that only applies specifically to New South Wales, who still have really substantial taxes on insurance. And what's happened in other states is that states have replaced taxes on insurance with emergency services levies, which are property taxes. If we were embarking on a stamp duty to land tax reform for a state like New South Wales or any other state, it would be really smart to also just fold your insurance tax replacement instrument together with your stamp duty replacement instrument and just have a single property tax. So I just want to really reiterate what John has said there, that there might be some smart bundling. Although on that, there's often an assumption that we should replace the current existing progressive land taxes with a new land tax that also replaces stamp duty. And I think that's worth a closer look. It's often taken as a given that you wouldn't have two land taxes on the book or two instruments called land tax. And there are some reasons why you might want to do the flattening of the current progressive land tax differently. So I think that's worth a closer look. I'll just drop that in there. Now, the second thing in response to what John has said is that a progressive rate might be really sensible for the replacement for stamp duty. A progressive rate might be sensible to minimise the distributional effects. And I guess I'd make another point that's quite similar and triggered by Warwick's finding, and the graph he showed that Queanbeyan prices or Canberra prices relative to Queanbeyan prices have risen very significantly by 20% from what I can see from your chart, Warwick. Now that seems mysterious at first, and if you're a bit of a tax wonk, you might be wondering if there's some kind of different capitalisation of a stamp duty into house prices vis-a-vis a recurrent land tax. That's all possible, but I think there might be a more straightforward explanation here, which is just that in rejigging the tax system, the ACT has skewed this progressively. So to some extent progressively, they've increased taxes at the top, and NatSem's work shows that the top quintile is paying more in tax. And for the middle three quintiles, taxes have fallen. Somehow at the bottom, I'm not quite exactly sure why, but the lowest income or the lowest wealth quintile are now paying more in property tax. So one, I guess, hypothesis about why this hasn't proved to be an electoral killer is just that the rich have paid more, which have allowed taxes to be cut relative to the old system for the middle income quintiles. Now that might be smart for two. So in other words, a progressive scale might be smart to minimize distribution, and a progressive spin on the tax replacement might be smart to skew the politics. So I think that's worth thinking about within this sort of overall topic we're considering of the political economy of tax reform. It's worth thinking about whether taking more from the wealthy as you go about doing the change can allow for cuts to a majority that can then ease the way to moving to a better or more efficiently designed tax. That's just really follow up John's point. Now to get to your question, Emily, I think so John's really covered two models for the transition. One is what the ACT is doing, and the other one is to effectively credit people some of the stamp duty they paid or refund some stamp duty. And you could, this is a thought, at a time when we need more fiscal stimulus to regrow employment, you could literally do that by refunding stamp duty, giving people the cash in a lump sum. Maybe, you know, anyone that bought housing in the last 10 years would receive back some portion of what they paid. So that's the credit model. And I think, in line with John, that this is probably the smartest way to go about the transition, because it means that you can get you can remove stamp duty immediately, more or less. You can ramp up to a full land tax rate pretty quickly. Yes, there's a revenue cost. Are we worried about the revenue cost at this point in time? Maybe not much. Are there easy ways to recover the revenue cost? Yes, you could charge a supplementary rate, as John alluded to. So I landed on this as being really the smartest way to do the transition. So I guess one other point is the ACT, or a gradual transition, and providing credit to the most recent buyers. They're not mutually exclusive. You could do a bit of both. It's worth raising a couple other points. So one is that there's a third model often suggested for how you would go out in the transition, and that's to simply exempt anyone that currently owns property from paying the new land tax. It would simply be that new buyers wouldn't pay stamp duty, they would instead pay land tax. That seems to be what New South Wales is considering. I think in short, it's a terrible idea. When you look at the numbers for what this implies for revenue, it's really staggering how much would be given up if you effectively grandfather this tax-free treatment for existing property owners indefinitely. Now, the problem with doing this is that only some 5% of properties turn over every year. So this is there'll be very slow additions to the land tax base. And when you run the numbers, as Prosper has done, and you can find it on the website, you'd find, I'm just going to check out, some ballpark figures are that if you do this, then over the first 20 years of the new land tax, you'd lose 60% of the revenue you would otherwise have raised if the land tax applied to everybody. And over approximately a full transition to get everybody into the base, call it 50 years, then you would lose around 20% of gross state product in foregone revenue. So for New South Wales and Victoria, that's more than $100 billion, which is just sort of an astronomical price to pay to ease the politics of this reform. Far better, I think, to narrowly target your tax concessions to the most recent buyers, which you would do via a credit. In my view, this full grandfathering approach would just be inferior, doing nothing. It's not worth giving up all that revenue. Now, the next thing I would add is that alongside any transition you like, but particularly alongside a model that sees land tax rates ramp up quite quickly, as in a credit model where recent buyers receive some refund or credit and everybody's paying land tax straight away, there are some things you could do to really change the politics around this. And the one that I profiled really in my report from last year was tax deferral. So John has alluded to this in the context of the asset rich, income poor. I asked the question, why would you not just provide this to everybody? Why wouldn't you let everybody defer paying the cash for the tax liability that they've incurred in this year and just whack it on the title and recover it when they finally sell the property? The point is that you can charge an indexation rate that's slightly above the state's borrowing cost. And that means that the more that people defer paying their land taxes, the more money the state makes in the long run via interest. So in effect, the state would be acting a bit like a bank with a mortgage loan. The state would be lending to property. We're lending you money so that you can avoid paying your tax this year, and we will take that money back with interest when you sell later on. So it's basically secured lending. It's risk-free because it's a charge on the title, just like a mortgage is, and the state would be first creditor in line. And the important point is that this really, okay, it might earn states some money. It's an additional revenue line. It could be quite significant, according to the modelling I did last year. But the really important point is that it could change the salience of the tax, the new land tax. People might sort of set and forget that they have opted to defer their land tax to the point where they sell in future. And it enacts this nice principle of equity, if you like, which is that the state will never kick you off your land if you can't stump up the cash. If you're liquidity constrained and you don't have the cash to pay your tax immediately, the state will never kick you off your land, but simply your inheritors who would have, you know, received this highly valuable property will get less than they would have otherwise. So for me, this is really a circuit breaking kind of idea. Now there's some, I guess, I think strange cultural reasons why people don't like to have debt on their title. I call them strange, but they're human apparently. People don't like this. They prefer to pay their taxes in cash. They really dislike living with a mortgage. But, you know, maybe these things are somewhat malleable in time and with the right incentives. So I'd like to see that really left field idea explored a lot more, that we extend, thanks Brian Kavanagh, that we extend this idea that we've narrowly sort of conceived of as narrowly limited to asset rich, income poor as something where you ought to means test or really, you know, limit to the neediest taxpayers. Why don't we just extend it to everybody and make some money out of it and change the politics of the reform? A couple of other things to note with it is that if that became really a default, then the new land tax, which is charged every year or every quarter, would actually typically be paid upon sale of the property. So it would look a bit like a vendor stamp duty. And if the optics of this was really important to politicians, they could even have the new buyer submit the land tax instead of the vendor. You know, maybe people would bid on a tax inclusive price at auction and they wouldn't care whether they're paying for the house or they're paying the accrued tax liability. So there are ways to redesign this that would, you know, change, I think, the optics of the reform. And essentially it would achieve this important property of keeping tax payments at the point of liquidity. So the benefit of stamp duty is that you pay it when you're paying a bunch of other stuff and you're getting a big loan from the bank. You are flooded with liquidity at the time. A recurrent land tax you have to submit every year is, it's a different matter. You might have a lot of wealth tied up in your property, but if it's not liquid wealth, then you may be in real hardship. So I say keep the replacement tax, one that's paid at the point of liquidity, and in practice do that by allowing everyone to defer their land tax to the point of sale. There's plenty more I could say, but it's probably about time. So I'll wrap up there and wait for questions.
Thanks, Tim. It's quite an interesting concept. We would you call that estate duties by stealth? Is that fair? Perhaps not. John, what do you think? We know in Canberra, for example, that we've just had a referendum basically in Canberra on the cost of living. The Canberra Liberals ran really hard on the problems to do with the cost of living impacts of the rates increases. And they were sort of trounced at the polls. And one of the things that they've done in Canberra, we know, is they've averaged the annual land valuations over 3 years to smooth out any price shocks. Perhaps, we've gone about this reform thinking that the politics are too hard, and we're often told that the politics are too hard. Perhaps Canberra's showing us that the electorate does have the stomach for significant tax reform. And do you think, John, we need to consider a deferred system, or do you think perhaps it's enough to have these targeted concessions that you mentioned?
I think Tim's arguments are pretty compelling. The only concern that has been expressed is if somebody has held their property for decades and decades and property prices have become flat, is that deferred tax starting to creep up above the property realisation price. Now, that's not history, and the rate's pretty low, and the probability of that happening is very, very low. And quite frankly, another way I look at it is intergenerational transfer of property. And so the sort of story now is that if grandma and grandpa die, they leave the grandkids with a $5 million house with no mortgage and no tax liability on it. If we take Tim's model, and grandma and grandpa have been asset rich and income poor for the last 10 years of their retirement, the grandkids get the $5 million property, but there's also a mortgage of the land tax that they didn't pay over the last 10 years. That strikes me as being fairly equitable. I think one of the biggest challenges we've got to get over in the politics is to explain the inequity of the current stamp duty. Basically, if people hang on to property forever, they're not contributing to government-provided health, education, and so on. Whereas those people who change property regularly are contributing much more than their fair share. And I think we've got to convince the electorate that we're bringing these frequent turnover property people into line with the infrequent property turnover people as equitable transferees. And the capacity to extend when you pay that is a way that's equitable. And as long as it's above the government borrowing rate, as Tim says, this is a government revenue winner. And we can probably even convince those silly ratings agencies that this is not adversely affecting state finances. So yes, I think all the arguments are pretty compelling.
Jesse, I wonder if you have a question for our panel.
Yeah, I guess the interesting thing with the deferrals is it all makes sense on paper and it seems really good. The only problem from what I know is happening in the ACT is even though they do have a deferral regime, it seems like not many people are actually taking it up. And people seem very attached to the idea, they refuse to take the deferral system, even if it means that they will suffer significant impoverishment in terms of cash flow. And so I'm wondering if the problem is really actually a behavioral economics thing related to that deferral system that might hinder its uptake. Even if you create a deferral system, the problem is people might just not want to use it. And it might make sense then as a policy justification for using saying, oh, the tax is fair because people have the option. But if no one is really considering it a valid option and using it, and then they hate the tax because of it, is that really sustainable then? We have to find possibly another way of doing it.
It sounds like a question for further research. Certainly, maybe one of the panelists could introduce what research has been done on salience, or what do we know about taxpayers?
I'll comment really briefly, but I think Jesse sort of nailed it, because maybe there'd be cultural reasons why an option like this wouldn't be taken up. But I guess one of the reasons I like talking about this is that I think the salience point is just a critical one to allow us to make better use of land taxation, of property taxation generally. I mean, there is a field, if you like, now called the political economy of property tax. Researchers are looking at this. There have been some good work done out of the OECD, because it's recognised that property taxes, land taxes in particular, are the most efficient taxes available to governments, for all the reasons probably this audience knows, but are underused, are extraordinarily unpopular. So we have these tax systems that, when you step back just a little distance, look really insane. You know, we tax people for going to work, and we tax their employer for hiring them, and we tax people for spending the fruits of their labor on whatever they buy, food, the rest. So we tax all the wrong things, and we could be taxing economic rents. So I'll just give you a sort of ballpark figure, which is that at current land values, land goes up in Australia. Land has gone up by about 9% per annum in Australia for 20 years as an average. At current values, that is about $500 billion, which is some 6 times larger than all state taxes put together. So the potential of land rents to replace distortionary taxation is really enormous. So given that, and given how difficult the politics needs to be, I think that it's worth having a real focus of attention on what the political barriers are. Clearly, some of it will be behavioural things, as Jesse's pointing out, to resistance to deferrals. People don't want to have debt on their property. But I think it's worthwhile. I think the reward for smart investigations of interesting circuit-breaking policies that could change the politics is worthwhile. I'll leave it there.
I've just launched a poll for our attendees asking, what would you do? We can do a tiny mini piece of research with a very, very small sample. Would you pay as you go, or would you prefer to defer your land tax? There's been some interesting questions asked, but there's a really specific one. We have a question from an anonymous attendee who is a residential homeowner in Ainslie, which is a suburb of Canberra. They ask, how much roughly would the rates have already been increased already? And is there still 50% to go? Concerned ratepayer in the ACT, wondering how much more. Warwick, perhaps you could tackle that one.
Yeah, I can try and rack my brain about that. But so more than half, or proportionally more of the rate hikes have been completed than the 8 years would say. So we're sort of a bit more than halfway there, I think, in terms of the rate hikes. But there are more to come, and stamp duties have still got a fair way to come down. So I couldn't tell you, of course, I couldn't tell you offhand what the average increase will be by the end. And in fact, the government announces the sort of annual rates as they go, and there've been several pauses along the way. So it would be tricky to predict, but you know, certainly there's still a few $100s in annual rates charges to the average property to come in terms of increases. But it's also worth noting that the ACT rates as they are not extraordinarily high when you compare to some other jurisdictions. You know, even my own here in Central Victoria are kind of comparable at the moment to current ACT rates. So the current rate charges in the ACT are not extraordinarily high.
Hey, Emily, would you mind if I interjected with a question for Warwick and maybe John?
Go for it.
Okay, it's really around, you know, how far we've come and how far we have to go, and what are the results of that so far. So, as one of the interesting points I got out of Warwick and Jesse's paper is there's basically murky evidence about this reform having done anything for turnover, which is the key metric that we would expect to increase if we are, you know, have a more efficient property allocation. So we just can't see anything. Apparently, the two commission studies are contradictory in finding effects on turnover. And I guess that sort of just raises the question, it's 8 years in, when more than half of the work has been done through the transition, we can't find evidence that this is making any difference. Do you think, Warwick and John, that the efficiency case has been maybe oversold? I think there's a strong equity case. John, you made it pretty clearly earlier, but we don't see much in the data for turnover. It doesn't appear to be sort of a ringing endorsement of this reform per se.
Yeah, I think that's a great question, and I reckon there's sort of multiple ways to answer it, I guess. One is that this is going to take a long time to play out, probably, in terms of its flow through effect, and the impact in terms of turnover is really right at the margins, right? If you're talking about a tax change that changes people's decision whether they're going to buy or sell or not, and we're having annual small changes in stamp duties and land taxes. It's pretty difficult to pick up that change. I would think in the ACT, you'd probably have a handful of people changing their mind. So you're just not going to, per year at this point, you're just not going to kind of see that impact until the sort of full transition has occurred and you've got more data, I think. So while I don't think we should count out the effect yet, it's also possible, as I was saying earlier, that home owner occupiers are not the economist's rational calculator. They want to live where their friends live, or they want to live where their kids want to go to a good school, or just get the best property they can get with their purchasing power at the time. And so your decision making in terms of influence of taxation is even more marginal for owner occupiers, I reckon. And we are seeing an impact, it seems, on investors and on commercial properties where there is that much more sort of cold, careful calculation. But yeah, I think we don't know yet, but it may be that the answer is somewhere in the middle, that the impact on efficiency isn't as great as perhaps the theory says it would be, but we shouldn't write it off yet before we've seen the transition. How about you, John? What do you think?
I think there's mixed evidence. There are studies, well, take the ACT, the evaluation. COPS found evidence of greater turnover. NatSem didn't. They used different data, they used different comparisons, which I think just highlights how hard it is to do this analysis. If you go back to earlier work by Andrew Lee, looking at differences of stamp duty rates across the states, he finds significant evidence of important effects on turnover rates. And there's been recent work done using Hilda data by an honours student at the University of Melbourne, who finds, again, significant evidence. So I think it's a very difficult area to analyse because there are so many different things affecting different states, different parts of the world, so that we don't get nice natural experiments. But there are quite a number of studies finding there is an effect, but there is a few others who find that there isn't. And so I would lend, it's not going the other way, so it's not causing trouble. It's a high probability it is giving us better utilisation of housing. And to go back to the really inequitable aspects of the current system, this is pretty much an overwhelming positive project to look at, in my view.
Yeah, I'll just, if you don't mind, I'll really quickly respond. Yeah, this is a very good point. It's clearly going to go in the direction we want on turnover and efficiency, but we can't see it yet for understandable reasons. I think if there's an implication of the efficiency case maybe being difficult to find, it's that we might not want to spend an extraordinary amount of money facilitating the change. Now, the model that's often looked at is where you just grandfather tax-free treatment for existing landowners at the time of the reform. When you look at the numbers on that, you start really asking the question of, is the juice worth the squeeze? It's probably a terrible metaphor right now. Is it worth spending all that money to achieve these slightly uncertain efficiency gains in future? Thanks, Emily and John. Warwick.
Thanks, Tim. I actually wanted to address one of the questions from the attendees. It's a good it sort of comes at it from a different way. We talk about, as economists, we talk about efficiency and allocation, and how this is a really great thing to have really efficient allocation of resources. But someone's asked, so people who are pro land tax want people to move more often. What about the effect on local community connectedness and social capital? Do we economists have a response?
Yes, it's a great question. I think, and it's not, absolutely not actually, that what we want is people to move more often. We want people to be free to move. We want to reduce the barriers to them moving. So in fact, the argument is really the opposite. So, if people want to move to be closer to family, currently there's a great big barrier to that, right? Or if they want to, move for other reasons, to be closer to their workplace, so that they spend less time commuting. So the idea is not to encourage people to move; it's to remove the barriers to people moving. Is the thinking that's sitting there. So I think that's the way to look at it, rather than encouraging people to move.
It's not punishing people for moving, which is what our stamp duty system currently does. And I think it was touched on earlier when we discussed the equity issues, but really to drive it home when we're talking about the stamp duty. I mean, I don't know if either John or Tim knows off the top of their head, or Warwick, what the proportion of the state's budget is drawn from stamp duty, and in turn, what proportion of the population transacts in a year. My understanding from Victoria was that something like only 4% of everybody in the entire state will transact property in a given year, while the stamp duty revenues account for, I'm not sure exactly the proportion, Tim, you can help me out, but a huge amount of the government's budget.
You put me on the spot. Yeah, it's about 4 or 5% turnover of the stock. So I guess it's around about the same of the population. Once commercial transactions are only maybe a fifth or so of total turnover. Stamp duty in the budget. So Victoria, for example, 6 or 7 billion in a budget of, someone out there will know the figure, but it's probably around about 60. State tax revenue is a bit less than that. So state tax is typically about half a budget. So stamp duty might be getting a quarter approximately or a third of state tax revenue. It's pretty significant. I guess one interesting thing about stamp duty is that there's a sort of each cohort comes through and pays a massive amount of duty. So yes, only 4% of the population contributes towards that 1/3 of state tax revenue in any given year. But next year, you're not changing house. Some other cohorts coming along and they're contributing to the lump sum. It's like we're all taking turns to cook for the potluck dinner or something like that. And the issue with that is just the question of how often is it your turn to pay for the potluck dinner, to cook the potluck dinner. And that's the equity point, is that if you are moving frequently, you're contributing far more than your fair share. Hope that answers the question.
Yeah, thank you. Sorry about that, putting you on the spot. Even though it is the cohort changes year on year, we often hear in the media and this idea that state governments are addicted to stamp duty revenues. So that informs other aspects of their policy, which end up sort of being pro-growth, pro-migration, pro-development, and boosting property market turnover. Warwick's written about this in the ACT, how there is this sort of inbuilt, gosh, what's the word I'm looking for? There is an inbuilt reason for the ACT to want to keep property prices high. Arguably, perhaps, is this whole idea of stamp duties being crack for the states overblown? What do we think?
Oh, maybe Warwick could comment.
Yeah, I mean, I think it's very difficult to give up a source of revenue like this that is paid at a time when there are very large expenses going on anyway, and that people don't sort of, it's widely accepted as a large cost of buying and selling a house, that this large amount of tax is paid at that point. So it's a sort of risky thing to to give that up on the basis of, replacing it with something that is more noticed by people. So, I do see that as the biggest barrier, that sort of giving up the big revenue source that's just passes without notice largely. People don't complain about it much, stamp duty, but they do complain about their rates. So the crack is hard to give up.
Emily, I don't know how you're going with time, but I could throw to a question to Warwick that's on a pretty similar topic.
Thank you for raising the issue of time, Tim. We are running out of time, but please feel free. We might can take your question, and then I think Warwick has some follow-up point to make, and then we might have to press the end button.
I think my question is probably so off topic relative to the political economy of tax reform that I'm embarrassed to say it, but I'll ask it anyway. So Warwick has this really interesting argument. It was in the Canberra Times recently, pointing out this dependence of the ACT on high property prices because their land sales are a large part of their revenue, and also because they, rather than like a local council, they don't set a rate in the dollar annually to recover a fixed amount of revenue to match their expenses, even though they do function as a local council. They have a fixed tax rate in legislation, or might be regulation, and that determines their revenue based on property market strength. So do they have this kind of dependence on this? And is it possible that the ACT is reluctant to lower house prices? And as Warwick points out, because they're the monopoly supplier of greenfield land, they can really flood the market if they want. I guess the question to raise, and the reason I'd raise it, is that there's a lot of grief given to planning regulations as impeding housing supply and contributing to housing unaffordability. The ACT is a nice example because you can strip out the middleman of the developer and their incentives to maybe delay housing supply. If the ACT wanted to flood the market with houses, they really could. They would rezone the land. Anyone buying it would have an obligation to produce a house, as Warwick points out. And Warwick suggests that this, tensions trade-off, this conflicted interest is causing the ACT to be slow on this. I guess the question I raise here is around, migration. So the ACT is a small place. If they flooded the market with new houses, people would just move from Queanbeyan to Canberra, and then other people would move to Queanbeyan, or people would move from Sydney to Canberra. And in the long run, and maybe even in a kind of medium run, people move in response to living standards, the wages, the traffic congestion, the rents. So I guess I just wanted to pick that bone with Warwick around whether the ACT government, as a small government, really could have any influence on housing affordability in their territory. Should it even be something that we ask states to worry about through their regulatory settings or their land release? Or should we just think about this as a function really rather of migration into this large market of Australia?
Yeah, I'll try and be quick, even though it's a complex question. I do think that governments should take some responsibility for housing affordability, sort of more broadly than just trying to supply low-cost housing. And I do think that they could do something about housing there. As you say, sure, if you did something that lowers prices in Canberra, people in Queanbeyan would move, right? But Queanbeyan is an even smaller pool. And what drives population in Canberra is primarily jobs. So, a lot of people aren't going to move to Canberra just because house prices are a bit cheaper, right? They're going to move to Canberra if they get work primarily in the public service or university. Those are the sort of driving forces of population in Canberra. And I don't believe that Sydney people would say, oh, it's a bit cheaper to live in Canberra, they'll go there, without a corresponding idea of what a job they might feel. And sure, they might decide to apply for a job in Canberra because of the standard of living, but their decision isn't going to drive up the number of jobs, right? So I think that's my very, very brief answer to your question. I think there is capacity because the cost of living isn't the driving force of people choosing to live in Canberra.
I think that's an interesting point to end the last point, because we've had a very interesting comment from Ed Wensing, who has been a long-term defender of the ACT leasehold system, and he's not so convinced that the election was a referendum on the cost of living, but rather a referendum on the Liberal Party introducing too many new initiatives all at once. So perhaps we'll know in another 4 years when we complete the third interval, looking at this transition, whether or not these cost of living issues come up. Warwick, did you want to say something to end us about the NAIDOC week?
Sure. Yeah, I just felt it was important to acknowledge that it's currently NAIDOC week, and the theme for NAIDOC week is always was, always will be, and the the finishing of that classic sentence is always was, always will be Aboriginal land, and we're talking about land and land tax here, and I'd like to acknowledge that Canberra is the lands of the Ngunnawal people, and I'm speaking to you from lands of the Jara people in central Victoria. And these are lands whose sovereignty was never ceded, lands that were taken by violence, and that we should acknowledge and remember that. And just to note that my organisation, the Castlemaine Institute, is committed to paying 1% of gross revenue to pay the rent in acknowledgement of the fact that we operate and live on stolen land. And I would encourage the rest of you to look into the pay the rent scheme.
Thank you very much, Warwick. And on behalf of the 30 odd attendees of our webinar today on this incredibly important issue of tax reform, and I think the point was touched on that given the amount of fiscal stimulus that the state governments are providing during the COVID downturn, these issues around tax reform and the efficiency and efficacy of the base are going to become more and more pertinent as we move forward and trying to enact budget repair. So please join me in thanking Warwick Smith, John Freebairn, Tim Helm, Jesse Hermans, our Policy Director here at Prosper Australia. Thank you very much for coming. If you're interested in more of our reports and research and commentary on this issue and many others that we cover at Prosper Australia, please go to our website and sign up for our e-news. We are, like many other not-for-profits at this time, suffering from the contraction, and we would be willing to accept donations from anybody who would like to support getting great policy around tax reform out into the public sphere. So please consider making a donation to Prosper Australia's Research Institute so we can continue to pay amazing people like Warwick and Tim to produce cutting edge research on the issues facing tax and land tax specifically here in Australia. Thank you very much, and we'll see you next time.
Thanks, Emily. Thanks, Warwick. Thanks, John.
Thanks, everyone.